The Indian economy grew by 5.7% during the first quarter of the current fiscal, hitting the slowest pace in 3 years. And now, all eyes are on the second quarter GDP print. The growth data for the second quarter is expected tomorrow, and the poll that CNBC TV18 has done shows that a rebound could be likely. Ekta Batra joins in now with the details. Ekta, this is the first set of GDP data which will reflect the impact of the GST rollout. So what are the key expectations, and will India possibly break the 5-quarter slowing trend?
Well, yes, absolutely. The street is very optimistic that there is going to be a recovery on a Q-on-Q basis for the GDP as well as the GVA this time round. Like you mentioned, it was a 13-quarter low in the previous quarter. So this time round, the GDP is expected to come in at around 6.39% versus 5.7% on a sequential basis. Now, remember that last quarter, yes, we did see the implementation of the GST, but in Q1 of FY18, we really saw the hiccups in terms of the rollout and how exactly companies, etc., were adjusting, and that seemed to have impacted the GDP data at that point in time. In terms of the GVA as well, that is expected to come in at around 6.29% versus 5.6% on a Q-on-Q basis. Again, an improvement on a sequential basis. Now, what exactly is going to lead it higher in terms of the sectors? I'll start with agriculture. That's expected to come in at around 1.9% versus 2.3% on a Q-on-Q basis. So there's not much in terms of agriculture expectations when you compare it to last quarter in terms of growth. But remember that the range is anywhere between 0 to 3% for agri. So I wouldn't really be surprised if it even surprises on the upside, according to some economists. Now, industries with construction is expected to be one of the key constituents for the recovery that we've seen. So, or we will probably see. So the industries with construction is estimated at around 5.5% versus around 1.6% on a Q-on-Q basis. And the majority of this is probably expected to be led by manufacturing, which could probably even inch up to levels of around 6 to 6.5% versus 1.2% in the previous quarter. Other factors such as mining is expected to pick up to around 5%, and electricity is also supposed to be quite steady at around 6 to 7%. Now, coming down to services without construction, it is estimated to come in at around 7.7% versus 8.7% on a Q-on-Q basis. So the street is expecting probably some slowdown to take place in the services growth. Again, the range is anywhere between 7.3 to 7.9%. In terms of the constituents, what is expected to slow down is the public admin section of the services segment this time round. So that is expected to come in at around 5.5 to maybe 6% versus 9.5% last quarter. Financial real estate should be okay at 7 to 8% versus 6.5% last quarter, and trade, hotels, transport too should be around 9 to 10.5% this time round.